Hello Propenomix people, and this is the Sunday supplement from the 28th of April 2024, and this one's called Mixed Signals. So, as you'll know, I like to start with a quote, and this week's is, "Don't let mixed signals fool you. Indecision is a decision." That's from Nitya Prakash. So before we get started, I want to say thanks to everyone who attended our property business workshop last week in London. It was a content-packed day and a super room, with feedback was the best I've ever received for anything I've been involved in, quite frankly. It was very motivating, and there were some fantastic conversations on the back of it, including a meeting booked in for a potential 8-figure deal afterwards. So as far as results go, that would be pretty sweet. So make sure you save the date for the next one. It's going to be Thursday the 4th of July in a central London location. Full details will be coming out at the end of this week. So welcome to the supplement, and we had another week where the immediate outcomes look a bit wobbly, but the real-time data that's in the supplement week in, week out bore the fruit we were expecting that it would. So the slightly backward-looking indicators look great, but this looks a little bit temporary is how I define that. Gilt yields just continue to drift upwards without too many reasons to snap the current direction of travel off. But if you think some of the UK forecasting has had a bad week, month, year, half decade, spare a thought for the US, which printed some incredible surprises, including GDP growth at 1.6 against an expected 2.5, and that was down from 3.4 last quarter. And PCE, which is the inflation alternative they often prefer to CPI, different makeup, different weights, and that moved from 2% to 3.7. Now it's expected to go up, but it's expected to go 3.4 and printed 3.7. So it's early days. Some of those figures might be revised a little, but there's a lot of missing out there that's gone on, especially on the GDP. And their 10-year bond touched 4.75% on the back of it, which looks massive when compared to, for example, Vietnam at 2.85. Tough to get your head around sometimes, for sure. But markets now don't really see the first rate cut, or first full point rate cut anyway. So remember, it's done on averages when they're looking at the market yield curve, until December in the USA. So it's nearly a coin flip as to whether there'll be a rate cut at all in the USA this year. I've hinted in recent weeks I don't feel particularly differently about the UK. I'm not ready to predict no cut this year as yet, as we have some different dynamics and are at a different point in the cycle. But we'll definitely flesh this out over the coming weeks. Anyway, this week's macro focuses on the PMI flashes, so those are the real-time estimates for April, confidence and optimism indices, which are both for businesses and consumers, distributive trades, which really missed a barn door in terms of the prediction, and the bond yields, of course, with a hat tip to what the Bank of England have said this week. So the PMI flashes have not been letting us down of late in terms of talking about the direction of travel. The expectations were fairly tempered for the month, but the services PMI, which really determines the overall direction of the economy since services are so massive, printed 54.9 against an expected 53. S&P Global, who own and distribute the data, put it succinctly in their press release. UK flash PMI signals accelerating economic recovery, but price pressures surge higher. Listen, I know I need to resist the temptation to say I told you so. No one listening to this or watching it will be surprised. The only surprise is that others might be surprised. They are seeing roughly GDP growth of about 0.4 per quarter currently, with a 0.3% increase in quarter one. Q1's increase looks like more like 0.4 to 0.5 to me, but let's see. Still, this looks very helpful for absorbing the hike in the minimum wage this month. The headlines other than that from the PMIs, this was an 11-month high, 6 expansions, which is readings above 50 in a row. Financial services and tech did particularly well in April, according to the survey, with transport and hospitality reporting falling output. I'd expect those were hit hardest by their minimum wage, of course. Measures of optimism over the next 12 months also remained high amongst the purchasing managers, well above the pre-pandemic average. In the details, manufacturing exports fell lower for the 27th month in a row, which is not a great trend, although services sentiment continued to lift higher. As with a lot of these graphs and this data, it's better to just ignore 2020 to 2022 or thereabouts. But in the image that I've used this week, which you can see on my LinkedIn newsletter or on the Partners on Property website, it's there just to back up quite how well the PMIs and the GDP measure correlate. It's fairly scary how strong that correlation tends to be, but not surprising. But of course, the point is the PMI data is out in near real time, basically, whereas GDP, we have to wait at least a month and a half after the event to see how it was doing, and then it might get revised and revised again and revised again. So we wait an awfully long time, by which point we can't use it for any of our real-time forecasting or for what's going on because things will have moved too quickly. So, good news for employment too, although not for rate cuts. Hiring picked up in the services sector, so the slide on the official numbers doesn't look particularly accurate, although the 2023 slide in the Flash PMI Composite Employment Index is being borne out in the figures at the moment. So that's what we saw playing out in Q1 of 2024, because this tends to play out several months behind in the real economy. This is kind of a leading indicator, not what we call a lagging indicator. Still, it doesn't suggest an unemployment tsunami coming at all, which will buoy those who think the minimum wage should continue to be cranked up and up. The loss of jobs accelerated in factories, however, so what this really does for inequality, I might question. Either way, the indices are hovering around the middle for services, just on the right side of 50 when it comes to employment, not roaring forward like the overall index is. Price increases still look consistent with a 4% inflation rate rather than a 2% inflation rate, and tend to be around 5 months ahead of where CPI is. That's in the services sector, which makes up 47% of CPI, as I say most weeks, it seems. The final paragraph in the S&P report is underreported. I didn't see it make it into one single press release this week, but it says it very succinctly indeed. Not a rate-cutting environment, similar to what the Bank of England hawks have been saying in recent weeks. I was stunned that a 50-50 bet was still available for June, although that's no longer the case now on a rate cut. But I was equally stunned back in December 23 that there was a 50-50 bet for March. I might have to start getting stuck into the betting markets on this stuff, because I think this mistake could be repeated over and over again during this cycle. In that paragraph, there's a nearly incendiary piece of commentary in the report, suggests that business conditions are more consistent with rate hikes rather than rate cuts. Both the composite Flash PMI output index and input cost index are above their long-term averages and rising. That's S&P's words, not mine, but probably worth heeding. Okay, so better news in the confidence indices. The business optimism index for manufacturers was at its highest since July 2021, even though orders have dropped as it printed +9 from -3, well above the long-run average of -7. Output expectations rose to a 6-month high. The cost of living crisis is over, on average, and those are the dangerous words, as we know. The softening of the labour market has also helped. Recruitment has got easier, by the sounds. The consumers? -19 was the GfK print, which is the equal highest print for the past year. Over the next 12 months, the +2 for consumers, that's how they feel about their personal financial situations, and that was preserved from last month's survey. That's the only metric that is positive. But everything is improved or stayed the same by a couple of points on the survey. More of that cautious optimism that I've been talking about. The last 12 months have been nowhere near as hard, according to the survey, as the 12 months before that. The savings index is also higher, so we'll be watching the savings ratios carefully as people still fear a harder landing, geopolitical tensions and the likes, and this is keeping consumption down. This is no bad thing in an inflationary time, to be honest. Savings are like tax, in that both are not consumption, but they stay in our pockets. So let's be clear that we vastly prefer that outcome to the alternative. So why are all of these important? Because they are historically very good bellwethers of anything other than true black swans. They are leading indicators. The point here is that at the moment, the health of the economy looks solid going into the election, in spite of relatively tough trading conditions and interest rates designed to slow the economy down. That provides us a stable housing market until the pre-election jitters set in. We need to prepare our businesses accordingly and also get on with it rather than waiting for rates to drop. Deals must stack at the current rates, which are not set to be edging downwards anytime soon. We should be taking prices for now on loans, not waiting for them to drift upwards, which we'll need to do very soon. Indeed, it's happening already. This is not advice, this is just what I'm doing across my group. If you're sticking around waiting for it all to go wrong so you can sweep up, I doubt you are unless you're a first-time reader or listener. Go back and broaden your horizons. That's not happening anytime soon. And inflation is organically going to drag prices upwards, not downwards. And so are wage increases, which are still expected to be around the 5% mark by the end of 2024. A quick nod to the distributive trades because the headline also caught the eye. Retail sales fell sharply in April, as everyone predicted because Easter was in March. However, it was even more than was expected, bearing that in mind. The expected print was -2 and instead it was -44. That's not a typo, that's just a bloodbath of a prediction miss. Let's face it though, retail is struggling anyway. Minimum wage will have had a major impact, and just because inflation has come down doesn't mean the high cost bases have gone away. Business rates for larger businesses are also going up, and that could mean some higher profile administrations, busts, Wilkinson style deals in the coming months is what I take away from all of that. And that leads us on to the yields, which is another week upwards, I'm afraid. We opened at 4.14, touched 4.295 on Thursday, closed Thursday at 4.266, and Friday at 4.246. That's all on the 5-year gilt, which is our usual sweat. The wobble was after the US numbers were released around their growth, and the US 10-year yield moving upwards dragged all of ours upwards, rightly or wrongly. However, if you take the words from before, from the S&P PMI survey, you'd think the yields were right to be doing what they're doing. They still feel a little bit on the high side though. I don't think there's too much above this in this yield. But remember, I'm not and have never been a bond trader. The Thursday night close for the 5-year swap was 4.186, so still in that range below the actual gilt, which is where we need to be. And don't expect that to change too much. There's no premium at the moment, and the higher the rate goes, the less the demand will be for that money. So again, as an aside, just to recap, why do I obsess over these so much? What are they telling us week on week? They're telling us that rates are not moving downwards particularly soon on mortgages. And then by extension, they're telling us that investment mortgages are still highly likely to form a very low percentage of overall mortgage debt being issued. And new units are going to be further and further between than they would be if the interest rates were lower. Stock won't be coming online in large numbers over the next 6 months. I'm talking about the rental market. That's effectively a guarantee. And even if business is relatively tough at the moment, with a constantly expanding rental demand in terms of a growing population and also a demographic that's increasing over the next 10 years, and that's the people aged between 20 and 30, we have a safe bet in terms of rental demand. That's a macro view. It varies from area to area, of course, but that's where we are. The price of credit will keep property investors away, even if they can get over all the hurdles that are in place that weren't there 10 years ago. The other side of the fence is that if rents increase faster than mortgage rates don't go down, or more technically, if yield grows faster than capital growth, has been happening over the past 18 months, then people will be more incentivised to get back to the market. So it's the chicken and the egg. Rents will go up because there's less stock, all else being equal, and there's more demand. There's also wage inflation. Increasing yields will finally bring more stock, but where do yields honestly need to be to tempt investors when the cost of debt is really around the 6 to 6.25% mark, fees included? Well, the answer to that is 8% plus. What's a sensible conclusion? The north-south divide that we've seen over the past 18 months in the property market, with prices in the south falling and those in the north rising, even in relatively small differences in terms, may well persist because the only investment property you can buy at the moment is in the north. That's a general public statement, not a supplement reader statement. You can still layer on active asset management strategies such as HMO on top in the south and force yield that way, of course. But standard buy-to-let is very difficult or simply not viable outside of studio flats or multi-unit freehold blocks. So in the week coming, we've got the US FOMC meeting, but the Bank of England rates meeting is not until May the 9th. So we'll have a gap after the Fed dot plot inevitably reveals that their members will follow the same pattern and let the cat out of the bag, that's not really in the bag anymore, that rates might not be cut in the USA this year. As an aside, this gives them a major debt servicing problem, a really major one. But of course, there's still 1.5 eyes on the Trump court case. Anyway, let's draw the macro chapter close for this week. I wanted to close this week with a nod towards the Renters Reform Bill. For those unfamiliar with the process, it has had its third reading in the Commons. There were over 200 amendments put forward, most very minor, others are not minor at all and some contentious. You will know by now that the position is very clear from the NRLA. Lose Section 21? Sure thing, but ensure there is a functioning court system for rent arrears and antisocial behaviour. The extra estimated 30,000 Section 8 court cases each year need extra resources in an already stretched system or an entirely new court. It's easy to see what the outcome has already been of all of this. Investors hate uncertainty, so they stop buying or they dispose of property. This continues while all of this continues. Any that read in the Telegraph predicting annihilation for landlords, obviously not feeling overly positive about a very likely Labour government, warning that the last 10 years of hostility towards landlords will be nothing more than a warm-up. The article says the war on anyone who rents out property is not going to end. Quite the opposite, it's only going to intensify. From price controls to compulsory purchases to higher taxes, this is not going to stop. perhaps until landlords are completely wiped out. The report concludes, anyone who thinks that tax rises and regulations of the last 10 years were as far as the state could go is kidding themselves. Now, the Telegraph are not the bastion of media they once were. Instead, they prefer scaremongering and clickbait these days, so I wouldn't look for the nearest cliff to jump off. However, imagine how many others are being put off, and imagine the market where there are yet fewer, but more vocal and powerful from a lobbying perspective, landlords in that market thanks to consolidation. Also, I hope Labour realise that damaging the market in transition is damaging the tenant, first and foremost, and the public purse second. Even those I speak to who may have to sell up because of higher rates and Section 24, before we even consider Section 21, have got a pretty penny in reserve after all of their taxes. They just don't want to crystallise and pay them all, nor do they want to get out of the game, but feel they're being forced out by legislation and by circumstance. We need great private sector landlords. The institutions are still a long way from picking up the secondary market stock with confidence, a long way. I've heard realisation of all of this on the left side of the commentary I take in on a daily and weekly basis. I hope that doesn't change and ideology doesn't take over, because, I repeat, the first and largest damage will be to the tenant. Once the third reading is over of the Renters Reform Bill, the bill will go to the Lords to follow the same process it has in the Commons. Timeline-wise, with elections looming, it will be close, and it won't be something that defines when the election is called, which is still feeling like late October or mid-November or something like that to me, even though people are muttering about summer elections. So, well done as always for getting to the end. Remember to save the date for the next Property Business Workshop on Thursday the 4th of July. It'll be at least as good as the last one from last week, whether you missed it or not. Now, there's only one way to deal with all the noise that's going on at the moment, of course. Keep calm. Always listen to the supplement and carry on. Thank you.